Hello everyone, and welcome to this Demica webinar, Demica Insight Q2 2024. My name's Dan O'Hara, and before we hand over to the speakers, I'd just like to take you through a few housekeeping points so you know how to participate in today's event. Firstly, you're using your computer audio to listen to the webinar. If you can't hear us, please close the webinar down and open it back up again, and hopefully you can see on the slide that you should be hearing through your computer. You are all in listen-only mode. That means you can't talk over the webinar, but the way we'd really encourage you to participate is by submitting your questions for the speakers via the question pane of your control panel. You can do that at any time during the session, and we'll come to those questions towards the end of the hour. Finally, the webinar is being recorded. So if you would like to listen again, or you have colleagues who wanted to join but couldn't, you'll receive a link to the recording within 24 to 48 hours after the session. With all of that, I'd like to hand over to my colleague, Maurice Benisti, to begin the webinar proper.
Thanks, Dan. Great to be back with you all again. Just to run through the agenda, joined here with Jonathan Steenberg from Coface, a great partner of ours. Jonathan's got some great and strong opinions that we'll be sharing on a range of things. We're going to talk about his view on the macroeconomic landscape. We're going to look at some of the sectors that we traditionally follow, and then also talk about some of the geopolitical changes, how that plays out in trade, and try and make it interactive. So welcome all of your questions, and I'm very much looking forward to the discussions. So if we move on, Dan. So I run the commercial team at Demica, and Jonathan is, as I said, the chief economist for UK and Ireland at Coface, has a long and distinguished career as an economist, and obviously, kind of well embedded in the world of trade, given Coface's market-leading position as a provider of trade credit insurance globally. So again, really pleased to have Jonathan join us. If we move on, perhaps to the next one. So I'm going to hand over to Jonathan, who's going to share some of the kind of key insights that that we'll point to on the agenda and generate discussion around. So Jonathan, geopolitical risks, some really dramatic looking charts here. You're citing the Middle East conflict. I'm sitting here talking to you all from Tel Aviv, so a propitious subject certainly for me and the Israelis around me, given events of the past 24 hours. But let's not focus on that. Tell us what you're seeing, how you're seeing that kind of play through into some of your estimates.
Yeah, definitely. Well, thank you for having me here, and thank you for letting me talk about the things I love to talk about the most, which is economics. So yeah, what we are seeing, why I want to highlight geopolitical risks, is that this year, in a lot of ways, is the year of politics, of geopolitical tensions, which are materializing both through elections. This is the grand election year. More than half of the global population has or will go into voting booths this year. We've already seen some of these elections. Some have gone towards the way of slightly more populism, authoritarian, but we've also seen some elections going the other direction, which is something we can discuss later. At the same time, it's a period in which we're seeing trade tensions intensify between certain big players around the world, the US and China as an example, but we're generally seeing some recalibration of what the global situation looks like. And the last way that geopolitical risk is high and intensifying is in war or tensions, and that is sort of what we're seeing down here. Obviously, we had the war in Ukraine a few years ago, which had very direct impact on the economy, sort of intensifying the increase in inflation and prices. And what we've seen this year, following the Houthis attacks, is a quite big disruption in global trade. And the best way to see this is really on the left-hand side here, with the ships, the transits going through key freight choke points. And as you probably know, the Suez Canal is one of the most important ones on a global level. And as you can see, following the attacks on civilian vessels, we've more or less seen the end of Western vessels going through the Suez Canal. They instead choose to go around the Cape of Good Hope, or sometimes even flying some of their goods instead as an alternative. Now, in an ideal world, this transit around the Cape of Good Hope should add about 10 days to the transport, given I'd say, perfect supply chain, and that's something I'll get to in a second. That would naturally, obviously, cost higher costs. That is 10 days of operation. That's 10 days of more fuels, 10 days of more labor. That's more ports to dock at along the way. But at the same time, what we actually also saw was quite a steep increase in some of the financial costs associated with global freight, with the insurance of some of these vessels initially increasing 70-fold. That has come down, but that was an increase of 70-fold for some of these vessels, which is also why they were quite clear they were not going through the Suez Canal, because some of the insurance companies were genuinely telling them, don't, you'll lose your cover. So that sort of resulted in quite a steep initial uptick, and that's what you can see on the right-hand side in container freight prices. That is operational cost, but it's also increased financial cost. But as you can see, this started coming down and then started ticking up again. Now, what is that? That is exactly what I mentioned earlier, that in an ideal world, this takes 10 more days. But the thing about global supply chains is it's such a finely calibrated motor that once you start changing one thing, suddenly the entire thing starts collapsing a bit. And that is what we've been seeing, because initially all the ships went around the Cape of Good Hope, but now they have to go back. And what we're now seeing is under capacity and over activity in a lot of these ports. So that is not just along the African coast, we're seeing it along the European coast, we're even seeing it in a lot of East and Southeast Asia, including the quite important Singaporean port, which is reporting over 5 days delays at the moment. So this is what we're really now seeing feeding into even higher freight costs, because ships are being stuck at these different key points along the way, which is really resulting in not just higher prices, but now also further disruption, which means you can't even just estimate with your goods being delayed 10 days. It's actually not sure when they'll come, because there might be delays in every single port along the way.
So it's not just distance, it's traffic.
Yes. Basically, it is proving to be quite a significant problem. And we also had around the Cape of Good Hope, there was a bit of bad weather. Now we're really dependent on that, which means suddenly trade started slowing down again, because we're so important on that one transit route. So yeah, it's over congestion, it's too much dependence on a pre-existing system, and now a few new key ports. So if we move to the next slide, this quite naturally feeds into one of the things I'm sure you're all very tired of hearing about, which is inflation. Inflation started increasing back in 2021, 2022, as I said, exacerbated by the war in Ukraine. And what we saw in 2022, 23 was central banks stepping into increasing interest rates to try to fight inflation and get it back. And what was really helping us during 2023 were these things we call base effects. So that's the fact that inflation is the price index difference on difference. So what's happening this year compared to last year. So what initially pulled it all back was higher energy prices. Now, these came down a bit in 2023 and in 2024, which means they suddenly started contributing negatively, which meant that they started pulling down inflation again. So it was what pulled it up, but it's also what pulls it down. But once these effects start ebbing out, suddenly the remaining part of the price basket starts mattering. And what we have seen is that wage growth is proven to be quite high in much of Europe and North America, which means once these negative effects start ebbing out, suddenly we are seeing it stabilizing at a higher level. And that is perfectly shown in the United States, which is again on the left-hand side here, in which that kind of stabilized once the negative contribution started ebbing out. That stabilized at a higher level because wage growth and service inflation thereby started being a lot higher. So this last bit has resulted in central banks suddenly being at a crossroads, because inflation is proving more sticky. At the same time, growth is actually proving slightly better than feared. US proved quite resilient, even if we're seeing a bit of a slowdown. It is still a very strong economy. We are now seeing 2 quarters of consecutive growth in Europe, hinting at a recovery here as well. So as a central banker, you're suddenly sitting in the problem that inflation is proving quite sticky. Growth is actually not horrendous, so you want to cut those interest rates, but you actually can't. And as you can see on the right-hand side, this has suddenly meant that the markets are realizing from the beginning of the year, where they thought there might be up to 6 cuts of 25 basis points by the end of the year, they are now more looking at around 2, and it should be added for the ECB's case, that is including the one that they already have done. And really all of this comes down to sticky inflation and a slow recovery. That means the central bankers suddenly don't have the nice, easy path that they were initially hoping for. If we move to the next slide, interest rates is obviously important to all of us, and it's particularly important to companies. What we have seen in the decade after the global financial crisis was a period of really nice low interest rates. I think we're all dreaming back to that period at this point, because if you're looking at this on the left-hand side, we're here looking at the average interest rate for new loans for non-financial companies. And if you were an average European company, you were in 2019 looking at a new loan for less than 2%. In 2021, less than 2%. Towards the end of 2023, about 5%. That is a very, very, very steep increase in your financial costs. And a lot of companies in this period decided to leverage more. In the decade after the global financial crisis, they needed to do so, and interest rates were low. And then COVID happened, which means suddenly a lot of them needed to leverage even further, and interest rates were again very low. So you have a lot of leverage suddenly having to work in a world where interest rates are a lot higher. You can see in the UK and the US, the example is quite similar, and quite a lot more significant for SMEs, particularly because they usually operate with variable debt to a far larger degree than large companies, which means some large companies have been very lucky. They fixed their bonds or the debt products for a longer period, which means they haven't maybe faced that yet. They are facing what we call the rollover risk. Once you try to roll over your debt, you're looking at a change from 2% to 6% at once. But for most of these SMEs, medium-sized companies, this has already gradually happened, and they're already suffering from this. And at the same time as the costs have gone up, we can see on the right-hand side that the credit standards from banks have also gotten tighter. That has usually resulted in one of 3 things. Either they expect a higher premium on top of the policy rate that's increased, so that is bad on top of bad, or they've been slightly more selective about credit limits, saying we can keep this one, we want to cut down on this one, we maybe not that interested in this sector, or in some cases they've completely cut credit limits. Now, this is the more extreme case, but we have heard people basically from their bank basically saying, you know what, this is a sector we don't touch at the moment. Sorry, no more credit limits for you. And this is really affecting them because their debt cost is high, which means for some of them they really do need that liquidity at the moment. So it is a difficult world in some perspectives. I do want to highlight that we're a credit insurer. I focus on risks. I want to add that, as I said earlier, we are seeing a slow global economy recovering. We are still expecting this year and the following year to be low growth years, but we are seeing some gradual improvement. But what we want to highlight is really on that company level, this year's difficult and the next year's difficult, because as you just saw, what we're expecting of cuts is maybe 50 basis points more towards the end of the year. Next year, in a perfect world, we might see 1 percentage point. If you look at that, what that means for a company, that is still a debt burden that's a lot higher than what they were used to just two and a half years ago. So I'll stop for now with the global outlook. But what I wanted to ask you, Maurice, is this something you're seeing as well?
Yeah, for sure. So we're seeing particularly the combination of the first 2 trends that you talked about, which is higher interest rates and higher for longer. It's driving companies to access lower form cost of capital. So that's a positive for those of us in the supply chain finance, working capital finance industry, because those products typically price at a lower margin. They're more secure products. and particularly on receivables discounting, we're seeing growth pick up as a result of kind of treasurers looking to make greater use of them. But at the same time, they're more sensitive to utilization. That's hitting payables finance and the take-up of payables finance programs, especially hard in jurisdictions where companies were using dollar-based funding, particularly in Asia, and the dollar has strengthened significantly, and they're reweighting themselves towards local currency borrowing. So they're much tighter around utilization, whether it's payables or receivables driven. They are much more sensitive to how much they're paying in aggregate. They don't really need the liquidity. So you're seeing customers that were on auto sale or suppliers that were on auto sale turn it off, being much more careful in the way they use the product because of the underlying cost. And even we were talking to a treasurer not long ago who was looking at whether they wanted to move from a structure where they were selling down large quantities of receivables as part of a program to one where they were able to be more selective, therefore looking at different structures. So you're seeing the product react to the macro. And I think when it comes to the geopolitical, it kind of depends where people are. Obviously, the closer people are to the source of the problem, I can only imagine what this is doing to the Egyptian economy, right? You've got, kind of tremendous pain being felt. The further away you get, well, at what point is that inflation seeping in to some of these trends, right? Is this being driven, it's hard to quantify, I suppose. I don't know how you, in your models, go about quantifying that, but how do those inflationary pressures come in, and where do they stack relative to others?
Well, I mean, just to take the example of Egypt, a perfect example of an economy that is very, very sensitive to this. It is very dependent on its income from natural gas. There was collaboration with Israel at this point, so that is again the geopolitical tensions there as having a massive impact on that. But also the revenue from the Suez Canal was a really key income for a country like Egypt. So it's having really tangible effects on the Egyptian economy. Where this is feeding in is, to be honest, a lot on goods, and we are seeing this at the moment. So North American, but particularly European companies, if you saw earlier, the compositive freight prices have gone up, but they've even further if you look at prices going into Europe. So what we're seeing right now is if you are importing things, especially from East Asia, you can see there the light blue and the yellow one are the ones going from East Asia to Europe, either the Netherlands or Italy, and they've increased even further. So if you are importing any goods, whether that's intermediate or final goods from East Asia, well, obviously they're delayed and they're going to be more expensive. So the big question is then, are we in a situation where you have the confidence to increase your prices? Is your consumer base ready to do this? We've already seen a lot of increases in prices. Do you suddenly dare say, ooh, this outdoor furniture, we want to increase the prices by 5% again? Will the customer base accept that, or will they say, you know what, cost of living crisis is still here, sure, it's improving a bit, but I'm going to hold back? So it's really about how sensitive is your supply chain, how much do you import from somewhere like, in particular right now, from East Asia, and if you look on the demand side, how much, what we economists call price elasticity is on the other side. Do you have the bargaining power, essentially, to increase the prices on the other hand? Because a key difference between now and a few years ago is that once we came out of lockdowns, our price elasticity was out of this world. We just wanted to go out, we wanted to experience, we wanted to buy things. We built up a lot of excess savings. We just wanted to spend money. So that meant when prices went up by 5-10%, we accepted it. We had the savings, we had the thirst to experience. But what we've been seeing over the last year and a half is this has fallen. And suddenly that bargaining power the companies had when prices were coming up, that is deteriorating. And that means either it eats into your margins or you might lose some potential revenue.
And I think that the stress that causes on companies and the increases in default rates and insolvencies, again, has a play into our product set. So whereas a large portion of our market is large investment grade companies who are using these products to tie their underlying capital requirements to their flow of goods and to their supply chain, smaller companies use it for liquidity, and companies that are more challenged from a liquidity perspective, they can't look back on the positive kind earnings progression to draw on revolving credit facilities and term loans, but they can continue to draw against funding that comes in off the back of selling their receivables. And we are seeing, particularly in the US, more and more private credit funds come into the market to exploit that opportunity and to build credit capacity off the back of that trend. So it's fascinating seeing all of this kind of come together and play out. Maybe, Dan, we go into talking about some of the sectors and start with kind of just an explanation of the data that you're going to see. And for those of you who've joined us multiple times, we take a subsegment of the 1,200 corporates that we've had on the platform since Jan 2020. That group has sales of about 100 billion, or had sales of 100 billion in 22. And we tracked the trends from when we started doing this at the beginning of the pandemic. We're the volume running through the platform since then has gone up from around, it's almost doubled. It'll be 40, we'll have 40 billion of assets by the end of this year and around 250, 260 billion of flow. So we're going to be changing the constituents as that happens, but right now we want to keep it even for purposes of looking at some of the trends, and this gives you the sector breakdown. And perhaps, Jonathan, you can explain how Coface looks at the world through its political or economic risk exposures and trends across region.
Yeah, so similar to you guys, we use the information we have, obviously being a global trade credit insurer, having this exposure across the world, having this also occasional claims experiences across the world. We have a pretty good idea of where growth is from exposure point of view, where more claims are, and we also have risk underwriters sitting in several of these countries, also having an opinion on a micro level. So we take all these things, which is our own payment experience, our own risk underwriters point of view, and we add this with the macroeconomic sentiment and several other parameters. If people are very interested, I can send you some documentation. But basically, what we usually say is we take all this macro, all this micro, and then we look at how will this affect different sectors in different countries. So we cover about 28 of the largest countries in the world. I believe that is about 85% of the global GDP that these countries cover. And then we split this into a very high risk, medium, or low risk of business defaulting risk. And as you can see, with how the world is, how it has been the last few years, we are seeing a bit more dark orange and orange than we'd like to. But what is a very positive story that we've seen in the last year in particular is that we are seeing some upgrades now. We are seeing some changes. This is the latest change from June. We review this every 4th month. And as you can see, we've generally speaking seen some different upgrades. We have energy in the Middle East, partly thanks to a bit more of a stabilization in oil prices after quite a lot of volatility. There's obviously still some underlying risks there, but generally speaking, compared to what we have seen, we do believe the world is looking slightly more stable from that front. One of the key ones that I believe we'll be speaking about is ICT, where we have seen some more country upgrades, and on a sort of a regional level, North America was upgraded to a low risk environment. Paper in Western Europe is one of those that is benefiting from a recovery improvement in trade. Retail in Latin America improved by real wages, as well as transport. I already talked about trade there, be rising in both Asia Pacific and the Middle East and Turkey. So most of the upgrades we're seeing here are derived from some of the macro elements we already talked about, and then how that feeds down into different sectors.
Great. So maybe we start with our conversation on ICT, computer electronics. So our chart on the left kind of tracks demand across our customers, or sales across our customers and volumes. And I won't dwell on this because we've covered it before, but you saw this significant kind of increase in demand as we went into lockdown, and a stabilization kind of ever since. So the cycle is reverting to a more kind of a more traditional, you still see the quarterly spikes, but a more traditional kind of pattern of growth. And 2024 you can see is kind of just under 2023 in the second quarter, having been close to it on the first. So nothing of note. But I mean, when I looked at we talk about hockey sticks a lot, but I looked at your chart on the right, and my question is, what's coming for us? Give us break this down, right? I mean, you don't often see charts going from 10 to 100 billion in investment in a 3-year period. It's fascinating.
No, so again, so we upgraded the ICT sector, and we upgraded in North America, particularly driven by the US. And overall, we'd say there are 3 key reasons why we are slightly more optimistic about the ICT sector. The first of it is geopolitical risk and industrial policy, and that is really what you're seeing on that right-hand side there. So those are announced construction for manufacturing related to computer, electronics, and electrical, and these start absolutely booming after the industrial policies that the Biden administration introduced. That is the Infrastructure Investment and Jobs Act, the Inflation Reduction Act, and the CHIPS Act. These all fed into supporting and subsidizing a lot more investment within these sectors. These are both semiconductors, etc. But we're also seeing this in a wider context, that in that way they are reshoring some of the things that they were previously outsourcing to East Asia and other places. So, this geopolitical tension, this recalibration of global trade is both meaning that some of the US neighbors are benefiting, but as we can see, a lot of it is also planning to come home. If I can quickly mention the 2 other ones. The second one is real wages. It's something I mentioned earlier. Nominal wages are quite high. Inflation is coming down, even it's proving slightly sticky, which means consumers in the US and in Europe are seeing more purchasing power, which means we do believe they will start buying more electronics and computers than they have in the last few years. And the last one is one that we talked about, Maurice, which is the IT renewal cycle, which is something we've been talking about for about a year now. But that is basically that most IT equipment has a 3 to 5 year life cycle, and what we saw during COVID, as you already alluded to here, is a lot of people and a lot of companies started buying IT equipment because you suddenly sat at home. So on a personal basis, I wanted a better TV, didn't I? Because I was going to sit a lot more home. From my company's point of view, they want to improve my computer. They wanted me to have a screen. They wanted me to have a setup that meant I could be as productive as home, which means we suddenly saw a massive boom in 2020, 2021. And if you then just pure math, really, you add 3, 4 years, 5 years to that, where are we? We are where we are right now, which means a lot of companies have policies that says we have to change the computer every 3rd to 4th year, which means it's almost pure mechanics that is saying, we are going to see this improvement because we basically have to replace the existing one. And Maurice, is this something you're seeing hints as well? Because you're saying there's a bit of stagnation at the moment. If we're looking at the second half of the year, are you getting an indication of some changes and some improvements?
Not yet. I mean, we haven't seen customers asking for increased limit, because that will really come through by way of looking at the capacity that's required within the system to accommodate the additional sales. And as you can see, the sales volume in the second quarter was still quite outside, but it's still sort of inside the kind of year-on-year growth that you'd seen in prior years. But as you point out, we're kind of 3 years in. So I think this is what you said should be a leading indicator for what we should expect to see going forward. The other thing that we have started to see amongst all the buzz that is in the market about AI, we have seen requests, and we've worked on a company request to solicit funding for investment in some of the kind of advanced NVIDIA chips that are used to drive the large learning models. And companies kind of stepping up to look at that as an inventory finance, but really the inventory is being deployed pretty quickly into their own capacity and use. So I think there'll be some shift from goods to services, but nowhere near enough to offset the increased flow of goods that will need to be replaced. So we haven't seen it happen yet, but on the flip side, we have seen the impact of businesses in different sectors that had a boost from COVID, where you don't get into a replacement cycle, right? More in-home purchases that last a lot longer than the 3-4 years, and they'd ramped up production, they'd ramped up inventory levels, and that has been a painful unwinding of inventory because demand just fell, and it doesn't show sign of coming back. Maybe that's the story for for another 4 years time. But there, any beneficiary of COVID that was related to more investment within the home, in the garden, furniture, and other things. And I think you said that the kind of shift from goods to services, obviously not for our electronics because everyone's addicted to it, but when it comes to other things, they're not going to sacrifice that for some of their leisure, related services, which continue to be strong. And I think that brings us on well to the next one on transportation. So we very much focus on road transportation, but you look a lot broader. So interested to understand how you think about some of the trends within the sector and some of the charts that we can see on the right.
Yeah, so I mean, actually, one of the things you just mentioned is key for this sector. So we, roughly speaking, break down transportation into 3 or 4 overall sectors. We have what we call sea transport, that's the freights we've been talking about earlier. We have the air transport, it's mainly dominated by passenger, that's all of us going to Spain, etc. And lastly, we have what we call land transport, which is road and rail, but mainly dominated by road, to be honest, which is what you just mentioned. So we have seen some upgrades here. A lot of that comes down to improvements in global trade. While there is many tensions, 2023 was sort of an outlier in the fact that global trade actually came down a bit, and what we're looking at in 2024 is a slow but an improvement in the number of activity. And as you can see on the right hand side, the container throughput index, which measures how many containers are landing in specific ports, there is a bit of volatility, but is still increasing. The increased purchasing power, the fact that people there still does seem to be some stocking, means that we have seen an increased level of activity in the sea transport, even if there is a lot of volatility around it. The air transport bit is, and you just mentioned the move from services to goods. Going on holiday is apparently an essential good these days. And what we've seen is air transport has increased at a steady, solid rate the last few years, and we are back above the pre-pandemic levels now for most of the key markets for tourism. So air transport is doing quite well. And again, there might also be a minor improvement from that point of view in the more freight part, where they might be stealing some of the activity from sea transport. The road one, which I want to ask you about, is one where we are a bit more worried about that one. We saw quite a boom in e-commerce, which obviously helped a lot of logistics. We saw an improvement in Deliveroo, etc. Basically everything that actually, if you think about it, meant a lot more activity on the roads. But we have seen that ebb out somewhat. So what have you seen here? What are you seeing of trend? What are you hearing from customers around this more road transport logistics point of view?
So it's difficult to disaggregate the impact of energy prices going up and down, right, from underlying demand patterns. From our customers, there's a continued increase in e-commerce. Like, e-commerce is not slowing down in terms of demand, and you can see that in transport and logistics, and we can see that in paper and packaging as the number of parcels on the road kind of continues. But obviously there's a lot of volatility given the underlying freight costs, which are heavily influenced by energy prices. So if you look at kind of 21, 22, where you had, or sort of 22, 23, when the impact of the Ukrainian war and a lot more uncertainty on energy prices, that was a driver. Whereas the first 6 months of the year has been lower. But I don't think that the underlying changes are going anywhere in terms of some of those drivers that arose out of the pandemic. And in other places, we're seeing a lot of demand for changes in the way credit is being deployed because of e-commerce, a lot of buy now, pay later. So you can certainly see a lot of capacity continuing to go into investment, whether it's in warehouses, whether it's in providing finance at the point of sale, and then underlying volume. So I think it continues, but the numbers are not clean because of the impact of other input costs. I don't know if that makes sense to you.
Oh, definitely. And I will say, while I will say that, when I say e-commerce is slowing, it's more slowing after a boost. So if you look at the underlying trend, it's definitely still going upwards. It's just more we had a bit of a sort of overcorrection there, which means we're still expecting it to jump down to a trend which is going upwards at quite a good direction. And once again, we have been through cost of living crisis in most of the developed world, and if we're looking at the latter half of this year and 2025, real wages are increasing, which we do expect to go both towards service sector, but also these semi-durable goods, which usually require some road transport to get to you. So it's definitely one where for the next 18 months there is some optimism there.
Yeah. So I think it stays steady. To your point, there's some adjustment after the boom, but it's probably somewhere in between kind of ICT, which has seen a permanent shift up, other durable goods where you had a boom that's not going anywhere, and here where you've got continued underlying demand drivers that don't go away, they just don't perhaps play at the same pace. Let me go on to the next one, which is automotive. So our automotive data set is driven predominantly from tier one suppliers to the OEMs, and you can see that demand just still hasn't recovered to its pre-pandemic point. I think interestingly, the number of companies that are in our system that are linked to EV growth is relatively limited. Of course, the components are different, and so the data sort of suffers in a way for not incorporating it. And we have seen some inquiries from OEMs that are procuring in completely different places goods that relate to the battery being, I think, something like 50% of the cost of the car itself. So as the whole supply chain readjusts, I'm not sure our data is reflective of the industry as a whole, but I'm looking at your charts, particularly for Europe and the US, which is more of a proxy for our data, and it doesn't look that different. In fact, it looks a little bit worse when you're looking at new vehicle sales. So interested in your perspective.
Yes, the automotive industry, it's an interesting one. I will start by saying your point about EVs. EVs is definitely an outlier here. They have been performing really, really well. Sales increase a lot across particularly Europe. The US is increasing as well, but I will say most European countries are seeing quite strong, often double figure growth for EV sales. So it's a place where there definitely is a lot of activity within it. If you look at vehicles as a whole, so combustion engines included, we are seeing a recovery, but as you're saying, it's a slow one. There's a reason why, from our point of view, it is still in this orange color, high risk in almost all sectors. Looking forward, I will argue that we are a bit more positive. Again, I've repeated the word real wage growth so many times, but that will increase our disposable income. Cars are something you really can postpone. So that is something where it made sense. Once the cost of living crisis hit, you don't say, I want to buy a car. You actually hold back. But what's also really important about durable goods in general, so that's car, your bigger appliances, is they're usually higher correlated with the interest rates because you take on debt, you borrow to buy these, which means when interest rates have been as high as they are, it's another reason why you might not make these purchases. And again, if we look over the next year and a half, well, interest rates might be coming slowly down, but they are coming down. They are going in the right direction. Real wages are coming up. So we do believe, from the demand point of view, we are in an improving situation. there are still some supply chain issues. There are still some geopolitical risks in this that are quite important, and something we can maybe discuss later if there's time for it. So there are some sensitivities, but if you look at a car salesman, I don't think his number one question is what is happening with geopolitical risk. His question is, can people afford the car, and can they lend money if they can't? And if those two factors are improving, well, then we do think that the car sales as a whole will start going in the right direction.
And in terms of imports from China, that's a whole new dimension to the automotive sector. And there's, kind of clearly concern from European Union countries and the United States to what that does to the domestic sector. How does that kind of factor into your evaluation of risk, both in terms of the competitive challenge that it poses on the incumbents, but also just more broadly in terms of patterns of trade and the fact that China's becoming a large exporter of vehicles, which has it's normally been the other way around.
Yeah, I mean, it's something that is very interesting and obviously will have an impact. The big question is, how will the flow go? Again, if you look at the underlying demand, well, if we have cheaper credit and improving real wages, we do believe people will consume in Europe. The question is then, will they consume European or American cars, or will they buy Chinese cars? And what we have seen is, yes, Chinese EVs are a lot cheaper, and to be honest, they are also relatively good products, to be completely frank. And in a lot of ways, they have been earlier and better at investing in this. We have seen some tariffs, some tensions arising from this. I don't imagine this to stop. I do think that we will continue to see this. A lot of this will come down to Germany. Germany is it's not the only, but to a large degree, it's the automotive industry of Europe. They have been one of the most pro-free trade parties because they export so much, and they particularly export automotive to China. What we're hearing from China is, though, that they want more domestic Chinese to buy domestically produced Chinese cars, which means you could counterintuitively see if we are seeing this trend goes, well, then Germany's big reason for being very pro-trade, which is the fact they can export automotives, not mainly, but also to a very large degree to China, that's already starts diminishing. So in that way, a better sort of domestic production and better domestic demand in China might lead to a harsher Europe that might be a bit more restrictive on tariffs, because basically, they see this as a give and take. We import something, we export some things. If you aren't playing this game, if there's no exports going out, then there's no imports coming in. And so I could see that intensify unless we find some sort of new equilibrium where particularly the German automotive industry will still have pretty good sales going to China.
Yeah. So turning perhaps to back to the geopolitical, we've got a lot of elections coming up. We've had elections and we've got more coming up around the world. As an economist, when you look at different regions, what are the things that keep you up at night the most? Where do you where do you watch most closely, where the polls are tracking, perhaps?
What keeps me up at night is a young baby, but but the second thing is that we have had a few elections. I will say the elections we've had to a large degree has not gone as badly as some feared. Again, we saw the Polish election actually to a large degree turning more towards a pro-globalization, a pro-EU path. We saw the Indian election actually limiting the power of Modi to a certain degree, meaning that he now has to work in a coalition. On the other side of it, we had a very strong election in Mexico, which gave quite a strong majority to a potentially, let's see how that develops, but potentially could be a bit of a populist and maybe even nationalist government. Again, let's see how that develops. So we have things that go in either direction. What forward-looking is keeping me up at night is probably the US election. It will be interesting. I think both sides are still not nationalistic by default, but there's definitely is a focus more on made in the US that the Democrats also adopted from the Republicans. But what we are seeing is potentially, if it did go the way of the Republicans, that Trump might be a bit more antagonistic, and potentially open to being a bit more, I wouldn't say destructive, but for example, his just adding a 10% tariffs on everything would be a massive disruption. Whereas as the previous Biden, the current Biden administration has introduced a lot of tariffs, have changed the trade patterns, but have been far more clinical about it. So the big fear there is, while I will say, the overall path of the US, I'd say is actually to some degree relatively similar. Either of, it's more the instruments they choose to use, and if we are to trust Trump in what he says, adding a 10% tariffs and everything would be a proper knock to the US and to some degree the global economy, because I'm not sure how that would work, frankly.
I'm not sure he is either, and trusting Trump on doing what he says, that's a brave strategy. We've got a question. Yeah.
I was just like ask you very quickly. So you're sitting in Israel. It's something that I've been peripherally mentioning so far. Speaking of geopolitical risks affecting an economy, is that something you're sensing, sort of, on the ground? Is that something you can see, you can sense, you can feel?
Yeah, for sure. I mean, you've had a huge percentage of the population that has been called up and served. So I was talking to, I dinner with someone last night it was, and he'd spent 200 days of the past 9 months in active service, and he's a reservist, right? So you've got a real strain on the on the population from the perspective of the impact that has on the labor force. It's very regional. So if you're in the north, the economy has effectively been put to a halt, and and there's massive impact. And if you're in the south, sort of it's recovering now. You still have a large number of people displaced from their homes. So the impact of war is very present. More broadly on the economy, I think companies are, they're on the one hand, people came back after October the 7th. They came back to serve. So you had, I think, 300,000 Israelis jump on a plane to come back to Israel. And that was a real kind of reinvestment in people's attachment to the country. But foreign investors looking at investment. So we're talking to another customer who's looking at future kind of production capacity. At the moment, 60–70% of their production capacity is in Israel. Well, where do you invest going forward? So across all spheres of the economy, there's a lot of uncertainty. There's defense budget. The defense budget is going to go up, and how that gets paid for, what's the impact, kind of long-term impact on businesses, no one knows. So you certainly do feel through interactions with people all of those impacts. Tourism is down 75% from the first 6 months of this year relative to the first 6 months of last year, and you see it. So I think it's just in the context of the global economy, it is a small economy, so it doesn't impact others as much as shocks to Ukraine and other places. But I think the big question is there going to be further escalation? How long does this go? And that does have much broader geopolitical impact. So it's a resilient country, and people are kind of hunkering down, and they're still out in restaurants in Tel Aviv, and it's still happening. But you have pockets of the country that have suffered and will continue to do so.
There was a question, if we have time.
Yes, there was. The question was on how differently do expect the UK government to approach trade policy? And more broadly, interested in your first reactions to the Labour government, because not necessarily what you'd expect from a Labour government. They've come out strong on a number of things, and interested in your read on that from an economist perspective.
I think general reaction is, I mean, they promised to be a pretty safe centre-left government, and they have come out being a pretty safe centre-left government. So far, I will say they've done what they promised. They've also done what most of us expect, which is now to say, oh my God, it turns out there wasn't as much money as everyone else said there wasn't going to be, but we're probably going to have to raise taxes. The Conservatives would have had to do exactly the same thing, to be completely frank. I think there's a lot of ambition, and there's, not to be mean to the previous government, there's more of a longer term plan in what they're planning to do right now, and I think you can see that in financial markets as well. They like the fact that the Labour right now are talking about a 5 and a 10-year plan. They're talking about an industrial idea. They're talking about increasing construction. They have larger plans, and they have less internal division on many of the key topics. If we're talking specifically about trade policy, I do think it's one where they are quite restrictive. I think if you look at the fundamental support of Labour voters, they're probably a lot more pro-EU than the average Conservative is. But if you look at sort of the constituencies where Labour won, Reform UK was the second largest party in about 98 of them. That means they are still very sensitive to, they can't go too much pro-EU. And we did hear Keir Starmer being very clear in saying, we're not rejoining the EU, we're not rejoining the single market, we're not rejoining the customs union, and we won't have free movement. So the biggest impact on the economy, really, which would have been changing one of these or all of these, he's pretty much ruled out. He is saying that they will be looking at renegotiating some things with all the limitations they've put. That's going to be interesting. But I did hear someone use a phrase that I quite liked, which was that a big trading relationship is kind of like gravity. Unless you fight it, you will go closer with each other. And if Labour won't as proactively fight it as the Conservatives did, I do think we will see a slow, gradual improvement in the trading relationship, but don't expect any major changes in the UK because of this. But regarding the trade policy point of view, there will be some minor ones. I think there'll be some gradual ones, but they won't do any major things in especially not in their first term.
And I suppose stability and a large majority kind of counts for something, right? From an economist's point of view, it gives you a bit more predictability. So perversely, we might be looking at the UK government as a more stable anchor in a very unstable world. Who knows? We'll have to wait and see. I think the last question which has been posted is the extent to which higher interest rates are going to drive more companies towards working capital finance. I commented on that a little bit earlier. I think the answer is yes. They're just going to be smarter though around the way they use the products, right? Because higher interest rates mean increased costs. So working capital products, working capital finance, supply chain finance products, I think their use of them will be more tailored to underlying kind of trade needs rather than being used as a kind of liquidity tool that could generate surplus liquidity at a cost that could be absorbed by the business. That cost can no longer be absorbed. But again, relative to other forms of borrowing, revolving credit facilities, there's a cost advantage, and there are new players coming into the market who are able to be more creative around product development. So I think that that should see that should net be a positive, but it is different in different places and across different products. So I think we've come to the end of our time and questions. Jonathan, it's been an absolute pleasure talking to you. Really insightful. I've really enjoyed it. I hope you get some sleep. And as you say, I don't think it's going to be any of the kind of hotspots in the world or economic trends that keep you out, rather than your 5-month-old. Hope you get him settled down soon and get some sleep. And we hope to welcome you back here another time. Thank you very much.
Thank you so much. It's been a pleasure and a fantastic discussion. Thank you.
Take care. Bye-bye.
Bye.